I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you.
The U.S. Fed has hiked rates as they were expected to. The big question, do you think they will hike them 3 or 4 times this year or stick to 1 or 2 more?
Well, it's very interesting because this morning the Fed Fund futures had only a 38% chance of 2 hikes, meaning 1 in September and 1 in December. And as you know, the press reports were all mixed on what they want to do, and apparently they decided to hike and then suggest that they'll do 2. And I think so far, you know, the reaction in the market's a little muted, but who knows, you know, it tends to gyrate the 2 hours after a Fed cut, and then you got to see what happens the next day to see what the real move or reaction is. But what I'm interested in and was looking as a possibility today, it didn't happen, is at some point we're going to see a real shift with these Fed statements and see the Fed actually start to pause on the interest rate hike. So if they would have done just 1, that would be a sign that probably in September or October they're going to start to change up and talk about pausing. And the reason why they want to do that, or I should say Federal Reserve Chairman Jerome Powell wants to do that, is because we're starting to get to a flattening yield curve, meaning that if they were to raise rates another whole percentage points, the interest rates on the 10-year bond would become lower than what they are in the 1-year bond. You'd get an inverted yield curve, which for market traders and people watch interest rates would signal a recession. It would cause people to really dump stocks and make all sorts of changes, and they just don't want to, you know, get to that point. So at some point they're going to pause these rate hikes. And the problem is that, and this is probably why they went with saying 2 rate hikes, is historically, for decades, the Federal Reserve has said that when unemployment gets down below 4%, it's a tight labor market, it's going to create inflation, and their mandate is to prevent inflation. And we've got unemployment now below 4%. That's the official unemployment number that they use on television. Now, what's happening is since Powell has become the Fed chairman, he's been telling people under him to research and find reasons to come up with to say that we can have unemployment below 4% and still not have big inflation. And I don't think they've come up with a new theory for this yet. But at some point they're going to. And interestingly enough, before he even became the Fed chairman, he was giving speeches in interviews saying this is what he wants to do, this is something that's needed, we need to find a new theory. And the thing about Powell is he was a lawyer, he worked on K Street in the Carlyle Group, and then he was a big lobbyist with a bank group on K Street in Washington, D.C. For increasing the debt ceiling back in 2010 and 2011. The point is, he's a lawyer. Lawyers are trained to make arguments, and he's in a political position as being head of the Fed. So I think his job is going to be at some point to make an argument to stop raising interest rates. But to do that, he's going to have to say we can keep unemployment at these low levels and not worry about inflation. So at some point, I believe we're going to see a Fed meeting where afterwards he's going to give a press conference and say we're pausing, and then announce we've got a whole new theory on inflation and employment and so forth. And that event should light a fire under gold and silver and really fuel a rally there, because it'd be a signal to everybody it's off to the races. This actually happened in 2006 with Ben Bernanke. He stopped raising rates that year, and gold had a big run in the first half of that year. And then the next Fed Reserve move was in 2007 when they began to cut interest rates. So what means beyond gold and silver, which I think is what people should be invested in to prepare for that moment. And the thing about it is those prices are so depressed that they could just go up beforehand anyway, especially silver. Silver has resistance at 17.5, and it's just been below that level almost all year long. And the commercials in the futures market have reduced their short position of silver at their lowest point in 3 decades last month. So I'm got investment positions and all this to position myself ahead of time. But I think it means there's very little downside risk, even if gold were to sell this news tomorrow and, go to 1260 or something. I just think it would be a buying opportunity. But, people in the United States, most of them don't trade gold or silver, much less invest in it. Have zero interest in it. And for them, what I want to say is that the Fed said 2 rate hikes, and we've had many. I think you said 17 or something, or 7 since 2008 rate hikes. You were talking before the interview.
Yes, 7 since the financial crisis.
Yeah, so 7, and if we get 2 more, that's 9 total. That means we're really reaching the end of this rate hike macro cycle, and then a new cycle is going to take over. And that cycle, when it happened last time, it took a year for the stock market to really start to dump and the Fed to lower rates. In 2000, it only took a couple months. The Fed raised rates, I think, in June, and by August, everything was crumbling. The NASDAQ, of course, took a dump that April. So I'm not trying to time it all or say 3 months or 2 or a year or whatever, but you got to be aware that we're late in the innings of this cycle, and the next cycle will come. And when you have a lowering cycle or towards the end of a pause at the verge of a lowering cycle, it typically means lower stock prices. And this cycle that could be different because the bond market, we're seeing junk bonds and corporate bonds all well off their highs last year, trading. The corporate bonds are below their 200-day moving averages, so there's already sort of a bear market going on there, which doesn't really seem to matter now, but if it continues going into the end of the year, it will put a damper on stock buybacks, which have been the main fuel for the stock market rally. In fact, this quarter we've seen record stock buybacks for 3 months, more than any ever before. We saw a $100 billion buyback announcement by Apple the beginning of May, which sparked a little run in the stock market that month, and we kind of need more buyback announcements when the next earnings period comes, I think, to keep the market up. I just look at things week by week when you're this late in the game. Now 10 years since 2008, 10 years from 2009, 9 years from the bottom of 2009, a little over 9 years, 9 years and 3 months, basically.
Well, Bernanke has warned the Fed that the effect of the tax cuts and dropping regulations will only last a short period. So if they continue to hike rates, it'll actually pound the U.S. economy a lot harder than they might think it will. Do you think that's a valid point?
Yeah, and that's exactly why Powell, before he even became Fed chairman, was talking about these rate hikes at some point. And the biggest problem, I think, that the United States now has is, and this isn't something Trump himself created. I mean, it's been a trend for a very long time. The United States' government deficit is growing and growing, and this year we now have an $800 billion government deficit. Trump talks about the trade deficit, and that's something that on the surface seems to impact American jobs, factories moving overseas and this kind of business.
So what's the real problem?
What we have is a massive government budget deficit of $800 billion this year, in part thanks to this is really the cost of the tax cuts, but also increased spending. We've increased spending in this year's budget, and that has an impact, of creating a bear market with bonds. Foreigners become risk averse to continuing to buy our debt, or they demand higher interest rates because of this, and that's in the long run what I think is going to create the trouble of the next crisis, which is exactly what I think Bernanke is talking about. Whereas in the last bear market of 2008, it was really falling real estate prices and the banking crisis that was the big event. And this next big event is going to be the problems with the budget deficit and the bond market. But we're not at that point yet. I mean, that's something that's going to take time to become a problem. Bernanke says 2020. It could be next year. I can't really predict the moment, but it's not in the next couple months. But it's a slow tectonic. I feel like, I'm living in I'm not in California, but I feel like as if I were in California and the ground is starting to shake and, earthquake's going to come, but, no one else can really see it or feel it, unless you got the detector to tell it's there.
We'll have more with Mike Swanson right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're chatting with Mike Swanson. Mike, President Trump now says he wants to punish the people of Canada and cost them a lot of money because he doesn't like what Trudeau is saying or doing. Is this the right way to run an economy?
Well, when a long time ago, it seems like a long time ago, but when Clinton ran for office and Ross Perot is running for office against Bush, I remember Ross Perot, and I liked Ross Perot because I lived in an area where jobs were moving overseas, and Perot was talking about this type of stuff and saying we need tariffs, we need to stop China. I don't remember him saying anything about Canada, but the same basic idea that when we have foreign trade we're losing, and so forth. But as time has gone on, I've come to realize that those jobs really aren't coming back no matter what, especially in the area of the country I live in, North Carolina, the Virginia area. It used to be textile jobs. They're gone. They're low-paying jobs. They're now not even in China. They're in India. They're not coming back. But more importantly, I know more about economics, and there's no way to get rid of there's no way to get rid of these deficits without ending the government budget deficit. And because what is happening is when we run a deficit of government spending, we've got to fund it somehow. And the way we fund it is partly by selling goods to Canada, to China, and those countries use the profits to buy our debt. So the only way we can cut the trade deficit to zero is if we cut the spending budget deficit to 0 too, and Trump isn't doing that. So the whole thing to me seems to be kind of wacky and nonsensical. And I know it's good for two groups of people. It's good for steel barons like Wilbur Ross, who like tariffs because what they really are taxes on his competitors. And he's one of Trump's biggest campaign donors. His personal lawyer is really the point man for this whole tariff thing with Trump. But the other group are the voters who lost their jobs in a lot of these Rust Belt states. But, you know, who think like I did, 20 years ago about this stuff. But, you know, it's just not real. I mean, but it's good for polls. But, other than that, and then, you know, you're not even getting into the larger ramifications of foreign policy. Do we want Canada to be our ally? I mean, the Canadian, armed forces have people in Afghanistan and you know, same deal with Europe and on and on. But in the end, I don't try not to get too caught up in Trump as a person, because the bottom line is, everything kind of started to go south in the United States in 2008 with the bank collapse. We never really fully have recovered. We have a weak economic recovery. The GDP growth is still below 3%, even with the stimulus of more spending and the tax cuts. I thought when Trump won it would be higher than 3%, but it's not. It's just, that's not his fault. It's just a symptom of the underlying weakness. But Trump won because of all these problems of the past and people being upset and not an Obama nor Congress, and either party for that matter, really fixing things, much less preventing the crash that happened. And I think that's the underlying malaise that Trump rode into office with. But when you have an economic downturn, the worst since the Great Depression in any country, you're going to have the country either go left, sort of like Franklin Roosevelt did in the 1930s, or go right, in a reactionary right-wing type president is what we got. And what their platform, a right-wing platform, is basically, you know, help your donors and take the anxieties and anger people have and channel it somewhere, and that's what Trump does every single day on Twitter. But it's not going to fix anything that's all these problems. The tariffs aren't going to fix it. Tweets aren't going to fix it. The tax cuts aren't going to fix it, unfortunately. And it's just, we're going to head for another downturn, and that's just the way it is, because and it's going to be worse than the last one. So it's just, but I know that sounds like a downer to people, but you know, people want to hear how to make money, so buy gold and silver. And even if this doesn't happen and it's not that bad, gold and silver in a position, especially silver right now, where they can go up. You know, say the Fed pauses, and that helps fuel all this stuff next year. And things aren't ever as bad as I was saying. Well, it's still, you know, fine. You know, it's just like 2006, gold and silver went up, and so forth. So, the thing is, I think it's easy to get caught up, you know, with this daily news cycle and get excited about it if you like what's happening, or disturbed by it if you don't. But you can't let all that distract you from looking at what's going on in these markets and trying to actually make money. And that's an important thing, because a lot of people are distracted on the other side by being too positive and thinking that, oh, I just don't have to do anything because Trump is there and he's just going to make it go up forever or something, and I don't have to think or look at my account or do anything. And that's kind of the opposite. You don't want to be too pessimistic or too optimistic. So you just gotta do your homework, you know. That's not the message I want to tell people.
We'll have more with Mike Swanson right after this.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the US. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the US and GET in Canada. Find out more at glancepay.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Mike Swanson. Mike, is something somebody should be reminded of, and I don't know if anybody can remind the president of anything, but what happened, for example, is Adidas shut down all their factories in China, laid off 1 million people, and replaced them with a mega robot factory in Germany that employs 60 people. So even if you do bring the factories back, they're not going to employ the people they used to.
Well, that's a good point. Okay, because my background is before I got into the markets, I was a master's degree student in history, and I had a professor that was one of the top labor historians in the United States, and I thought about him a couple months ago and looked him up on YouTube, and anyway, he was recommending this book, and I went and got it, and it was written by one of the former labor secretaries, and it was really interesting because what the argument was that in the United States, and then actually Jerome Powell needs to search for an argument for why wages aren't going up, even if a tight labor market, and they're not. And this book explains the main reason why, and it's not the jobs going overseas. So it's something else going on, and that is outsourcing of almost everywhere you go. So I just give you one example. You go to a hotel in the United States like Marriott, and you go in there. Marriott usually owns the building, but the workforce is independent contractor, and they might have a cleaning staff that's separate. And there's all these, like, you could have 3 or 4 different companies operating in one building. It's all outsourced, and that drives wages down because it makes it impossible for the workers to unionize, and then these companies that are providing these services are all under pressure to also have the lowest cost service available. That's actually the main driver of this. But this is going on with Apple and Adidas. These companies outsource most of their labor to places in China and overseas, and those companies can be using robots, whatever, to drive the wages even lower and lower. So it's really this outsourcing phenomena that's the key factor, more than really at this point, foreign competition or jobs going overseas. But what's unique or different, or what's happened that I didn't know or fully understand, is that what's enabled this outsourcing to actually take place is the internet. Because what you need, if you're Apple or Adidas or Walmart, or whoever, and you have all this outsourcing going on, you got to keep track of what everyone's doing to make sure they're still building good products, that these people you're letting do your work are doing what they say. And it takes real-time surveillance and data to know that's happening, and to enhance the internet. Before the internet, this wasn't possible. So it's not just the jobs I saw when overseas in the late 80s going on. It coincided with the rise of the internet at the same time. So it is a technology factor. The robots is the easiest, physical manifestation of this, but it's computers, it's the internet and all this kind of stuff. And I don't know really what is going to stop that. And I mean, there are legal ways it could be stopped. For instance, they could change the laws to say when you're doing this outsourcing, you really are still responsible for the labor conditions, and right now they're not, and that's why they do this outsourcing. in theory, judges could start making rulings like that. There's no sign that that's about to happen, or I don't know if we're even talking about that. So, but the bottom line, I think, is when you talked about the robots, you're suggesting there's a big thing out of control involving technology behind a lot of this, and I think that's absolutely right.
Yes, as a contractor, you don't have the same rights as an employee does.
No, not at all. And even worse is the people that are hiring you, typically in these subcontracting situations, are companies that can be small and not even have very thin profit margins themselves. So they don't really have much leeway to. They could be on the verge of going bankrupt, or if you were to get paid more, they're out of business. So there's that much slack there for people to have better working conditions.
Mike, thank you so much for chatting with us.
Thank you. Great talking with you. Our
guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com Radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.